Today, we are going over indicators. Indicators are going to be some of the most important tools you will need to learn, understand, and how to use as a stock trader. If you know what indicators to use, you will essentially be able to predict where reversals are going to happen. And where reversals happen is where you can make the most money. If you actually think about it, stock trading is a game of just understanding where a stock is going to turn at. If you know where a stock is going to move up at, you can buy the stock and you'll be able to make money. If you know where a stock is going to move down towards, you can again short the stock and you can go ahead and you can make money. Let's start breaking this down. Let's start talking about this. What are indicators? Let's start with the fundamentals of indicators, the definition of indicators, and let's go over some of my favorite and most popular indicators. Lastly, we'll figure out how they work and how we can use them to be able to predict the stock market. So, first things first what are stock indicators? Well, stock indicators or technical indicators are going to be mathematical calculations based on the price volume or open interest of a security or contract used by traders who follow technical analysis. So when it comes down to our stock trading, you might want to add as many different indicators as you can. And I understand that concept. Because when you are a newer trader, it seems like you just want to add everything you learn. From different moving averages, to simple moving averages, to exponential moving averages, to the RSI, to these different clouds, to the MACD, to all these different, pivot points, to this and that. And the thing is, guys, when it comes down to your trading, sometimes you add so much that you can't really even see what's going on anymore. How many times has you ever looked at a chart and it starts looking like this, right? We don't want to get to the point where it just seems like we have no idea what we're even looking at anymore. And wherever we start trading, we start second guessing ourselves. Sometimes we have so many different indicators on our chart that it looks like it's like spider webs going all over it. It's like, okay, I'm going to buy right here. Oh, I can't buy right here. This indicator says no, but this indicator says yes. But this indicator says it's only going to go this high, but this one says it's going to go down this low. So the thing is, less is more. What I honestly suggest you guys do is maybe pick 1 to 2 indicators at most and be able to say to yourself, hey, this is what I want to use. These are my favorite. These are the ones that I think make the most sense. Because once you guys start overcrowding your charts, the indicators honestly become useless. So what I like to do is use the most popular indicators. I use about 3 to 4 different indicators at most, and I use the most popular indicators. Now, why do I use the most popular indicators? Well, the most popular indicators, of course, are going to have the most strength. And the most strength from the most people using them. So for instance, if we have a stock and we have an indicator where everyone's using the same indicator and it's saying that you should buy it right here. Well, if there's 100 people in the stock market, I know 80 of them, 85 of them who use this indicator will be looking to buy. So I know I'll be on the right side of momentum. If there's a very popular indicator that, again, this indicator is saying sell the stock, I know I'll be on the right side of momentum. So it's extremely important that we use the most important indicators because these indicators are going to be the ones that make you guys the most money. So we'll dive into those, which ones they are in a moment. But before we get into that, there's actually 2 different types of indicators, which are going to be overlays and our oscillators. So what we have here is overlays. Overlays are going to be technical indicators that use the same scale as prices are plotted over the top of the prices on a stock chart. Examples include moving averages and Bollinger Bands. So if we see a stock with, again, an indicator in the actual chart over the price data, that is going to be an indicator. Okay, that's going to be an overlay. If we have an oscillator, this is going to be a technical indicator that oscillates between 2 local price points, a minimum and a maximum, and they are going to be above the chart or below the chart. So don't worry, I'm going to explain absolutely everything to you guys. But the very simple concept is if we have the stock, let's say, in the chart, this, again, green line, this blue line, and this 200-day moving average would be overlays because they're overlaying the price. Underneath, or if I had anything above, would be our oscillators, which is, again, above or below the chart. So there's 2 different types, and I want to make sure you guys understand them because I'm going to use about 2 to 3 different overlays, and I use about 1 to 2 different oscillators. So as you guys can see right here, this would be an overlay. We could have the actual price of the chart. We could see the candlesticks of the chart with our indicators overlaying on top of the actual price. Very simple, very easy to understand. We also have the oscillators, which are going to be beneath or above the actual chart. If we had overlays, they would be going within the chart, within the candles at this time. These, of course, the oscillators go underneath or above. So let's start diving in on these. Let's start talking about them. And let's start going over the most popular indicators that you guys want to be using. Now, if you ever hear anyone say, I have a super secret indicator, I have a super secret stock, I have a super secret, indicator that's going to help us, be able to make money, it's not a good indicator. Just like if someone says I have a super secret stock, it's not a good stock. Because in stock trading, it is a game of numbers. When you have strength in numbers. If I have 100 people and there's 100 people in the stock market and all 100 people use the same indicator, we'll technically know where everyone's going to buy and where everyone's going to be looking to sell. If you have a super secret indicator that only you use out of, again, the multi-millions of people who trade, it's not going to work. Strength in numbers. Strength is understanding, okay, everyone's going to buy at this area. Not you are going to buy at this area. You need to think, what is everyone else liking? What is everyone else using? Because that's what you want to use. The reason why I don't have any super secrets that I keep to myself is I want to teach you everything. I want to tell you all my strategies and tell you all my secrets, because the more people who know it, the more people we're going to be able to understand, to work together, to be able to see stocks move in the direction that we want all at the same time. So let's start breaking down these very popular indicators that are going to help you make the most money. First thing is going to be the 50-day and the 200-day moving average. These are going to be some of the best right here. A moving average is simply an arithmetic mean of a certain number of data points. The only difference between a 50-day moving average and a 200-day moving average is the number of time periods used in the calculation. The 50-day moving average is calculated by summing up the past 50 data points and then dividing by the result by 50, while the 200-day moving average is calculated by summing the past 200 days and dividing the result by 200. So this is very simple and very easy. Simply enough, the 50-day moving average is going to give us the price point of the stock over the last 50 days, and the 200-day moving average is going to show us over the last 200 days what has been the average point. So something I want you guys to understand right away is I only use these on the daily chart. Let's talk about why we use them and why we only use them on the daily chart, okay? First things first, why do we use them? Well, this is the standard. This is the textbook. This is what everyone always uses. So when we go ahead and we take a look, let's go to www.stockcharts.com. We take a look over on stockcharts.com right here, and let's just type in Netflix. We type in Netflix, what automatically comes up? The 50-day moving average and the 200-day moving average. And you can see that this right here is the default on almost every single chart. All right, you take a look over on Netflix right here. We have this red line. This is going to be the 200-day moving average. And then, of course, we have right here this blue line. And that is going to be the 50-day moving average. And this is just telling us over the past 50 days or 200 days where the stock has been at. And this is going to help us get a great gauge and help us understand support and resistance, where the stock is going to turn at or where the stock could possibly bounce at. Now, we can look over on stockcharts.com. We can look over on trade ideas. We can look over on really any website. You can go to finviz.com. Go to finviz.com and click any sort of chart right here. Right when we get these charts, what's again the indicators that come on up? The 20, the 50-day, and again the 200-day moving average. Sometimes the 20 gets thrown in there, but notice every time you go to a chart website, it's always the 50-day and 200-day moving average that will always be there. So if that's what everyone is gauging, that's what I want to use. Personally, I don't care if it's the 50-day or 200-day moving average. I only use it just because that's what everyone else uses. If let's say one day everyone says, hey, we're no longer using the 200-day moving average, and there's a CNBC article that blows up and everyone reads it and says the new moving average is 312. I would use the 312 moving average. The only reason I use the 200 is because that's what everyone else uses. And since everyone else uses it, that's what I want to use to help myself predict the stock market. All right. Now, let's go over on why I use it over in, and really quickly, I want to refresh our Webinito. Webinito traders, you guys not with me anymore? Let me know. Webinito people over on, you guys still good to go? Webinito still good? AK-47? I don't know what you're talking about, man. All right. So AK's losing his mind. All right, cool. So let's get back to it. All right, so let's get back to it. Thank you so much. All right, so why do we only use it on the daily chart? That's a very important question. So let's just do a little bit of an experiment. Why do we only use the moving averages on the daily chart? Let's take a look over on ADTX. Now, when you head over towards ADTX, let's go to indicators. Let's just add SMA, simple moving average, and let's just add the 50-day moving average. Boom. All right, let's also, again, if we want to, let's add the 200-day moving average. Let's put this in red. That's kind of the set in stone colors as they always are. I got them off stockcharts.com. Blue is always the 50-day moving average. Red is always the 200-day moving average. And let's add this. Boom. So at this time, what do we have? In the blue is the 50-day moving average. In the red is the 200-day moving average. Now we could see at this time, if we take a quick little screenshot, let's take a little screenshot. We are in a 2-minute time frame. We are in a 2-minute time frame, and we can see the 50-day moving average is right around 199. The 200-day moving average is right around 169. What happens if I change my time frame? Let's say I want to trade in a 5-minute time frame. Well, what the heck just happened, right? Now, the 50-day moving average was 199. Where's the 50-day moving average now? 178? Where's the 200-day moving average? At 164? Right? This is way different than what it just was. Right? Way different than what it just was. So the thing is, during an actual day, some traders, while they're trading, always use the moving average on the 1, 2, 3, 4, 5, or 5-minute chart, right? You don't want to be using it here because you're going to say, hey, watch your bounce play coming on up. And people say, bounce play? Bounce play's not coming up for another 10 cents. And someone says, 10 cents? No, it's not coming up for another 50 cents. The best thing for you to do is use it over on the daily chart because everyone trades with the daily chart on. And the daily chart is going to help us understand over the past 50 days where the stock has been. Over the past 200 days where the stock has been. Using a 50-day and 200-day moving average on a minute chart isn't going to help you too much because everyone's going to have different answers over there. On the daily chart where they actually belong with the 50-day moving average and 200-day moving average, that's where we're going to have the most success using these. So we don't use them on the 1, 2, 3, 5-minute chart because it changes with every single time period. We use them on the daily chart because they are 50-day moving average and 200-day moving average where they don't change because everyone uses the daily chart. So why do we use them? Because they are the most popular. Then on top of that team, why don't we use them on the minute charts? Because again, they change too often. So let's start talking about this a little bit more here. So simple moving averages are often viewed as a low risk area to place transactions since they correspond to the average price that all traders have paid over a given time frame. Similarly, the 200-day moving average represents the average price over the past 40 weeks, which is used to suggest a relatively cheap price compared to the price range over most of the past year. Only used on the daily chart as we talked about. So what is the point of this? Deck, we've learned again what the 50-day moving average is. We learned again how we like to use it. We learned again, of course, why we use it. It's the most popular. But how do we make money off of it? Like, what is the point of even having it on our chart? Well, it really comes down to it shows us support and it shows us resistance. These areas show us where a stock is going to reverse at. So when we take a look over on this play, we can see right here, 50-day moving average. We hit the 50-day moving average, the stock stays above it. We hit the 50-day moving average, the stock stays above it. We are underneath the 50-day moving average. We come up to it, the stock gets resistance. We come up to it, the stock has resistance. So this would be very nice because if I know the stock is coming up towards, again, the 50-day moving average, I could look to short here. And if I short this play, guess what happens? The stock starts dropping. And I see it start moving its way back on up. And it hits the 50-day moving average, I could short here. And guess what happens? The stock starts dropping. Just like if I wanted to bounce it right here. I know, again, it holds up as support. So when you're above the 50-day moving average, it holds up as support. When you're underneath the 50-day moving average, it holds up as resistance. Notice, where would be the best area to sell this stock? The best area to sell the stock would be when the 50-day moving average is hit. Okay, I don't know where to sell. Well, let me sell where everyone else is going to sell. Why do we use these? We use these because we know the majority of traders use them. And since the majority of traders use them, this is where everyone is going to be selling these stocks or, again, technically buying these stocks. So what we have here is sell off, sell off, sell off, sell off. This shouldn't be shocking on why everyone is selling. We know that this is the most popular indicator. People sell when we come up to it. Now again, we have a target on every single trade that we want to get involved in. The 200-day moving average is very similar as well. People sell at the 200. People sell at the 200. People sell at the 200. We break the 200-day moving average. Guess what happens? The stock again bounces off the 200, bounces off the 200, bounces off the 200. Now we're back underneath the 200-day moving average. And again, you start falling underneath the 200, underneath the 200. And that holds up as our resistance line, underneath the 200, so on and so forth. So you could see it just gives us a great understanding, right? A great understanding on how these plays work, a great understanding on why we want to be getting involved in these plays. And we could, again, use it on, any of these plays, right? We could take a look over on, Netflix, or let's just, again, take a perfect example over on the SPY, right? The SPY, this has been something that has been absolutely awesome over, again, the past 9 months. We actually just started cracking it here, as you guys can obviously tell. And what I mean by this is we can take a look over on the SPY. Look at how great the 50-day moving average has helped us. If we take a look over on the SPY, we know every time where to buy the SPY. Every time it comes down to this blue line, we know that it's going to be time to get involved with this play. Eventually, what does happen? The stock does crack the 50-day moving average, and now it's underneath the 50-day moving average. But look how many times traders bought in on this. Is it odd? Is it weird that everyone bought in on this play? It's just everyone knows this moving average. And since the majority of people know this moving average, we know that we should be buying in on at this time. And that's why, again, the SPY is a very predictable play, because people following the moving averages. Just like if it ever came on down towards the 200-day moving average, that would be a great area to start getting involved in. So again, the SPY, definitely something we want to continue to keep our eyes peeled on, because we can see how great the 50-day moving average was. Just like when we're underneath the 50-day moving average, that held up as a very strong resistance line, which turned the stock back on down. So you guys are probably understanding now why we use the 50-day and why we use the 200-day moving average. Let's keep it going. What else can we be looking at on these plays? We can also be looking at the exponential moving average. Now, what is the exponential moving average? Because we just went over simple moving average. The exponential moving average is a type of moving average that has placed a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponential weighted moving average. An exponential weighted moving average reacts more significantly to recent price changes than a simple moving average. So, what we use here, again, I can explain all this to you. But the very simple answer on deck, why do you use this? Is because this is what everyone else uses. The most popular EMA, which is called, instead of SMA, this is EMA, which is the 13. Once again, team, we only use this on the daily chart. We don't use it on the 1, the 2, the 3, the 5-minute chart. This is what I like to call the flexible trend line. And again, the flexible trend line at this time, this is going to be a play that we want every single trader to be on top of. All right? The 13 EMA is going to be extremely important. Now, why do I call it the flexible trend line? Well, the 13 EMA, let's just go ahead and take a look at some trend lines. When we go ahead and we look at trend lines right here, we know trend line. Anything on the top side is considered bullish. Anything on the bottom side is considered bearish. Anything on the top side is considered bullish. Anything on the bottom side is considered bearish. Anything on the top side is bullish. Anything on the bottom side is bearish. Bullish, bearish, right? Bullish, bearish, bullish, bearish, bullish, bearish. It's very simple to understand that. So anything on the top side of the 13 EMA is going to be considered bullish. And once you go underneath the 13 EMA, that is when you are considered bearish. And that's, again, something I want all traders to understand. So let's take a look over on the SPY right here. The 13 EMA is going to be the best indicator to use when you guys are looking for long-term investments. So as you can see, let's again just put this in green. I'm going to make this a little bit thicker here, right? So this is, the 13 EMA. You can see me tracing it a little poorly. So here it is, tracing it, tracing it, tracing it, tracing it. And then, of course, it starts dropping right here. As you guys can tell, the 13 EMA, just like the 50-day moving average, it does hold up as a support line. But essentially, all it's going to show us is as long as we stay above this green line, we are considered on the bullish side, which means buyers are going to be more in control than sellers. The moment we go towards the underside, is where we are considered bearish, which means sellers have control or shorters have control. So if you ever want to go long term on a play, you always want to go long term when you are on the bullish side. Because going long term, let's say on the SPY right now, you are on the bearish side of the trend line. You would want to see, again, the stock go on the bullish side. So you can take a look at a lot of different plays right here. Let's just take a look over on, let's say, Netflix. Netflix, guess what we have at this moment? We can go ahead, take a look over on this play, and we could see the 13 EMA. The 13 EMA is that flexible trend line point. So as long as you buy when you are above the 13 EMA, you are considered bullish. And you can see sometimes we get a little testy here and there, but we are still above and bullish on that play. A great example I always like to show, and again, you could see this all over the place, is I like to always look at like CEI. CEI is a great example that clearly, shows, basically the stock going from one side to the other side. So, or not CEI, excuse me. I mean, CEI, since we're here, we might as well just take a look at it, right? CEI. Let's just see what we have right here. Here's a great example. It's not even the stock that I want to bring up, but hey, that's how great the 13 EMA is. You can see how awesome it is. When we have the 13 EMA, here's a green line. We are considered bullish. How many times, let me ask you this. How many times have you guys ever jumped into a play and you didn't know where to sell? You say, Deck, I want to keep holding this play, but I don't know where to sell. I don't know where to get out of it. Well, from now on, if you want to hold this play for multiple days, as long as it holds above this green line, you're bullish. 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 What's so great about the 13 EMA is that you guys never need to be fearful. Because even if you have these little red days, like this red day here and this red day here, you don't need to be scared. And the reason why you don't need to be scared is because CEI, it's bullish, 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 bullish. Even with a red day, it's still bullish. Bullish, 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 and it goes on this massive spike. All you guys have to do is say to yourself, as long as it stays above that green line, I know buyers are in control and I know I'm still winning. The moment it cracks underneath this line is the moment that you want to get out. It's the same exact thing though on the downside as well. I mean, we'll just stick with CEI. And the thing is, team, I never try to have like examples lined up just because I'm so confident as I can click any stock and you'll be able to see exactly what I mean. CEI is a perfect example, right? Where we have right here, bullish, 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 bullish. Hey, Deck, when do I get out of the play? Well, now guess what happens? Bearish, bearish, bearish. Hey, Deck, can I buy it? I wouldn't. It's still bearish, bearish. Hey, Deck, can I buy it? Nope, bearish, bearish, bearish. Now we're going back to the bullish side for the first time. So it's very great for you to be able to understand all these plays. It's very great for you to be able to see, CEI and now be able to say, oh, wow, I know exactly when the stock is considered bullish and I know exactly where to see that the stock is considered bearish, right? So right here, these are great plays. Now, again, these are not plays that we are going to be looking at on the minute chart, right? We don't want to have any indicators on the minute chart. We want to have them on the daily chart. That's where we want to be using them. If we want to use this as kind of our flexible trend line, we have something else that we want to be talking about. And that's something else that we're going to be talking about. And I'm going to get rid of the moving averages right here. Let me go through this. Very simple. I'm actually going to just refresh my scanners. Is I only have one indicator on my minute charts, as you guys can tell. Now, what is that? What is, again, the one indicator that I have on my 1, 2, 3, 5-minute chart? And that simply enough is going to be the VWOP, right? So every single morning, I go ahead and add the VWOP. Now, you might be saying, Deck, why do you add the VWOP? And the reason why I add the VWOP is the VWOP team doesn't change and will only change a very small amount over from minute to minute. The VWOP right here is right around 280. Let's change it from the 1 minute to the 2 minute. Guess what? We're still right at 280. Let's change it from the 2 minute to the 3 minute. Guess what? We are now at 278. We went down 2 pennies. Still the same area, right? Let's change it to the 5 minute. Same thing, 278. So from the 1 minute to the 5 minute, we're still in that same area. That's still the same kind of like 3-cent price range. When we did it with the 50-day moving average, we were 30 cents apart. So the VWOP is the volume weighted average price. And in simplicity, make it as easy as possible, the VWOP is going to do exactly what the 13 EMA does on the daily chart. So do you guys like what the 13 EMA does on the daily chart? It tells us when we can hold the stock and when we can get out of a play. It shows us when buyers are in control and when sellers are in control. The VWOP is going to be that same indicator on the minute chart. And all we have to do is study this black line and be able to say to ourselves, all right, hey, the VWOP right here. Whenever we see that this line, whenever the stock is underneath this line, we know there's more sellers than there are buyers. And look what happens. CEI just again crashed and crashed and crashed and then boom. You know why? Because it's been underneath the VWAP the entire morning. Take a look at any of these plays. Take a look over on MARPS. MARPS hasn't even been able to hold anywhere near its VWAP, right? Take a look over on ADTX. Let's see what we had right here. ADTX team. Notice what we've had. ADTX this morning. It was doing great, right? We take a look. It was holding the VWAP, holding the VWAP, VWAP support, holding the VWAP, holding the VWAP. Then guess what happened? Then we had, again, sellers move in, and we cracked the VWAP. The moment you break the VWAP or crack the VWAP, you usually see a very nice move, either up or down, because you are changing the entire day from buyers being in control to now sellers being in control. So you can go through every single play if you guys would like to, and you could see when buyers are technically in control and when sellers are going to be in control, right? So that's why we always look at these plays, and you can look at, a lot of different stocks such as like Tesla. Notice how, again, I'm just doing everything from blue chips all the way to penny stocks. Notice what we have, on these plays a lot of times, right? Tesla, nice spike because it's bullish above the VWAP. But then guess what happens? We fall underneath the VWAP. Now it's holding up as resistance. It's having trouble getting above it. And then again, it starts falling back on down. The VWAP is going to tell us if buyers are in control or if sellers are in control. And whenever you're above the VWAP, you have a better chance of winning when you go long. Unless, of course, it's like a ginormous spike and you're trying to short, the peak. But it's the kind of simple, understanding. You're above the VWAP, there's more buyers than sellers. You're underneath the VWAP, there's more sellers than buyers. And that's going to be the same exact concept, of course, with the 13 EMA over on the daily chart, telling us who's in control, buyers or sellers. So let's just think about what we've had so far. What we have so far, team, is we have the 50-day moving average and the 200-day moving average. The reason why we have these plays is they show us support and resistance where stocks are going to reverse at. When we know where stocks are going to reverse at, we know where we can make money. We can buy or short. Then we have the 13 EMA on the daily chart. 13 EMA is going to be AKA the flexible trend line. The flexible trend line is going to be a great area where, of course, we can jump in on these plays, be able to make as much money as we possibly can, and as long as we stay above the bullish or the 13 EMA, we can go ahead and make profit. If a stock goes beneath it, we want to be looking for a short. Now, a lot of people always say, well, Deck, what do you use as your 1, 2, 3, 5-minute indicator? I use the VWAP because the VWAP has very little change between, again, those time frames. This is going to be the same exact concept as a 13 EMA, only on the minute chart, which basically just tells us who's in control. The VWAP volume weighted average price is going to give us that great information. All right? So let's see what else we have going on here. So I'm sure at this point, even if you are brand new in stock trading, you're probably saying at this point, you're probably saying, man, I'm starting to understand this. I'm starting to understand what's going on here, right? For that person that's maybe joining YouTube, that person that's just joining us in chat today, for that person that already knows this information, but getting, even just a little bit of a recap, even myself, who has been trading full time for the past 8 years, it's still great to review this information and just be like, wow, this is some awesome information right here. It's great to be able to just kind of take it and understand, once again, refresh your mind on why I use these so often. And okay, great. This is why I use them. So let's keep it moving here. Let's go over, of course, the RSI. Now, what is the RSI? The RSI is going to be the last indicator we go over. And the RSI, simply enough, team, is going to be the relative strength index. The RSI is going to show us when a stock is considered overbought and when a stock is considered oversold. Let's go to www.stockcharts.com and let's just we'll stick with the theme of CEI today. Seems like everyone's talking about CEI. We'll stick with the theme of CEI. Now, the RSI is the first oscillator that we're talking about. So what do we have here? Here's CEI. The RSI is going to be right here. Notice that we have a 90 and it drops all the way back down to about a 10. This right here is going to be your RSI indicator. right on top of the screen. Notice we have different numbers. We have a 70, which is very important. Let's just, again, try to make a straight line. It's going to be a little difficult on the mouse, but I'll show you right here. We have a 70 going across this line. Then, of course, we have our 30 going across right here at the bottom. So how can we use this? How does this help us? What are we looking for? The very simple concept is anything that's underneath a 30 or near a 30 is going to be considered oversold. Anything near a 30, underneath a 30 is considered oversold. Anything above a 70 is going to be considered overbought. So, how would this help us? Well, let's just again play this game and let's see what we have. Very simple concept right here is whenever you come down near a low, let's connect the dots and let's see what happens. And whenever you come up near a top, let's connect the dots and see what happens. So I'm going to say when the stock is overbought, we come up near around a 70 right here. Let's just again scroll on down. Guess what happens? When we get near the overbought side, guess what happens on this play? It starts dropping and starts dropping and starts dropping. Then again, what eventually happens? The stock is considered oversold, right? Gets right near around that 30. And then again, you got a couple little green days on up. Then eventually the stock starts dropping until it gets oversold again. Stock comes oversold and you have this very big climb until, as we can clearly see right here, guess what happened? Hold on, let me get rid of this a little bit. We can see this very big climb. Guess what happened? The stock became overbought. Now, when the stock became overbought, we had a nice little pullback. And it pulled back underneath that 70 on the RSI. Then the stock started spiking up even higher. And whenever we get up near like a 90 on the RSI, that's where, again, we get these hard dumps. Like CEI right now, we take a look over on this play, we could see that this play is getting this massive hard dump. And we can tell that because it's overbought on the RSI. Doesn't this make your life extremely easy? Where now, again, all you have to say to yourself is, okay, let me just kind of run through this real quickly, Deck. You're telling me every time I see the RSI above a 70, I can expect that sellers are going to be moving in? It's not at 100% guarantee it's going to dump on that moment you look at it, but it does have a great chance of dumping in the near future. Absolutely. Let's take another look at a very hot play such as XCNE. XCNE, this has been a relatively hot stock over the last few days. We take a look over on XCNE. As we know, the RSI, let's just play the game. Stock comes up near a 70. We can scroll on down. It's considered overbought, so the stock starts falling. It starts falling, starts getting weaker until it comes on down towards where? Near the 30. Near a 30, we know the next few days are going to start spiking us back on up until, again, it gets more near overbought. And once it gets near overbought, it hits the top, and then again, we know it's going to start selling on off. Once it starts selling on off, it keeps on falling until it usually comes back down towards around a 30 on the RSI, and then it falls back down towards a 30, and then the stock gets a nice little spike. Then as the stock gets a nice little spike, you do have, your highs right here, which leads to a drop back on down, which eventually led to a high right here, which led to a drop back on down, which made, again, the stock eventually become more oversold. And again, getting oversold, the stock, drops on down, which eventually, again, leads to the stock being overbought, which now, again, the stock is now going to start dropping back on down. Isn't this crazy to even look at? That it's like a great idea to be able to figure out how to be able to know which way the stocks are going to be able to make you money is just by looking at these indicators, right? Now, I'm going to tell you right now, just because you look at these indicators doesn't mean you're going to be super successful at stock trading. You still need to understand a lot about stock trading to know when to get the best entry. But this is going to put the odds in your favor. And that's what stock trading really is all about. The worst trader in the world has a 50-50 chance, technically. You can buy a stock, you can short a stock. It's either going to go up or down. But when you're a trader now, who knows that the majority of traders, let's say use the 13 EMA, 50-day moving average, 200-day moving average, VWOP, and RSI, now we can start putting the odds in our favor. Okay, hey, CEI right here has a 90 on the RSI. The stock is starting to fall back on down. I know it's considered oversold. Okay, where would the stock look for a bounce at? 50-day moving average back down towards 115, 200-day moving average back down to 105. That's where a nice bounce would be at. Okay, let me short this play not only because it's overbought, but also because it's underneath the bearish side on the VWAP. Notice how our 50-50 gamble just maybe turn into a 60-40, maybe turn into a 70-30, maybe turn into an 80-20, where we're not randomly closing our eyes and hoping for the best, but now we're waiting, being patient for our setup, and now again the odds are in our favor. We have an 80% chance of winning, a 20% chance of losing. We have a 10% chance of winning, a 90% chance of winning, a 10% chance of losing. We have the odds in our favor. And that's the beautiful thing about learning these indicators. I didn't make, again, $500,000 this year from luck, right? I would be the luckiest trader in the world if I'd been able to just do everything absolutely, close my eyes, hope for the best, and all I've been doing is 50-50s for the last few years of my life, right? Head over to lightspeed.com. You guys can see profit, loss, everything that I've done. I only have 1 month of red, 1 month that didn't work out. Other than that, I've been able to make $104,000 in a month, $135,000 in a month, $121,000 in a month. Over the past 9 months of trading, I've made $521,000. This isn't from luck. All I'm doing is putting the odds in my favor. I'm again trading when the odds are again going to be going with me, not against me. I know the majority of traders right here are going to be selling this play. I know the majority of players on this stock are going to be buying this play. I know they're going to be bouncing this play, and more sellers are in control here and more buyers in control here, and it has a high RSI here or a low RSI here. And this is how we're able to start predicting the stock market. This is a great understanding on how to always be on the right side of momentum. So, amazing job, amazing work. I wanted to, again, be able to work with you guys right here, teach you guys absolutely everything I know about these indicators to make sure that you guys are becoming better and better and better. If you have any questions about this, of course, please let me know. But as always, I look forward to seeing you guys taking this information and absolutely crushing it down the line. Awesome job.